At this very moment, investors around the world are looking at rising AI stock prices and saying this time is different. Corporate earnings are actually improving, productivity is going up, and GDP figures are hitting record highs. So why am I saying this is a bubble right now? Let's be clear about what a bubble actually is. A bubble isn't simply when stock prices rise a lot. A bubble forms when asset prices begin to detach from economic reality. The scariest thing about the current AI bubble is that corporate numbers are genuinely good. So why is it a bubble if the numbers are real? That's exactly the crux of today's discussion. The profits AI generates are real. But are those profits circulating through the economy as consumption that supports everyone, or are they extremely concentrated among a small group of companies? And when the government tries to solve this problem, is it actually creating an even bigger problem? These three factors are the bubble collapse triggers I'm going to discuss today. Let me be clear up front. I'm not here to give you a date for when this pops. Nobody knows that. What I want to give you today is an understanding of why this bubble is structurally vulnerable and what signals you should be watching for. Let's begin. Reason 1, productivity gains aren't circulating back into consumption. Imagine your company adopts AI and suddenly 3,000 employees can do the same work that 10,000 used to do. From the company's perspective, that's a massive success. Costs dropped by 70%. The stock market celebrates. But there's a question nobody really asks. Where did that savings go? The moment AI gets implemented, two flows actually start simultaneously. The first flow goes like this: AI adoption, cost reduction, increased net profits, stock price rises. This is real. It's actually happening. Microsoft, Google, and Meta all saw their profit margins noticeably improve after implementing AI. But there's a second flow. AI adoption, massive layoffs, reduced consumer spending, declining domestic sales. This flow is equally real. The problem is that the stock market immediately prices in the first flow, while the second flow appears with a time lag. 6 months, a year later, we see it reflected in deteriorating results for retailers, restaurants, and travel companies. Simply put, right now the stock market is immediately cashing in on the profits. AI creates, but the bill for the reduced consumption AI causes hasn't arrived yet. That's the core of this first vulnerability. Let me be specific. A senior software engineer earning $150,000 a year loses their job to AI. Immediately, they cut restaurant reservations, cancel travel plans, and delay buying a new car. This isn't just one person's story. Across the US alone, hundreds of thousands of tech workers were laid off during 2024 and 2025. What's more important is that this isn't low-income job losses. AI is primarily replacing high-income knowledge workers, coders, data analysts, legal document writers, financial analysts. When these people reduce consumption, it means a significant portion of total US consumption shrinks. The top 20% of earners in America account for over 40% of all consumption. The real data is already showing warning signs. America's credit card delinquency rates have been steadily rising since 2024, and personal savings rates have fallen to post-pandemic lows. Consumers are holding on through debt as incomes decline. Everyone knows this situation can't last long. In conclusion, the current rise in AI company stock prices is only half the truth. Shareholders captured the benefits of cost cuts, but the effect of those cost cuts eliminating jobs and reducing consumption hasn't yet fully hit the market. When that time lag closes, that's the first trigger. Reason 2. The benefits are extremely concentrated. Here's an interesting fact. From 2023 to 2025, more than half of all S&P 500 gains came from just 7 companies: NVIDIA, Microsoft, Apple, Google, Amazon, Meta, and Tesla. 7 out of 500 companies created half the gains. This means we essentially have two stock markets existing simultaneously right now. On one side are the AI beneficiaries. NVIDIA sold AI chips and made astronomical profits. Microsoft captured enterprise customers through Azure Cloud and Copilot. These companies' actual earnings are genuinely strong. There is real performance backing up the stock price gains. But on the other side, retailers, restaurant chains, and mid-sized consumer goods companies are already quietly wobbling. Multiple U.S. retail chains and restaurant companies are lowering earnings guidance. Mid-market companies targeting middle-class consumers have been significantly lagging the S&P 500 for years. We have two completely different worlds coexisting in the same stock market. Why is this concentration dangerous? Simple. When 7 companies are holding up the entire market, any shift in expectations for those 7 companies shakes the whole market. It's like a building supported by 7 pillars instead of 500. What happens when one pillar starts to crack? The bigger problem is that these 7 companies' stock prices have already priced in most of a future where AI dominates every industry. Take NVIDIA as an example. At one point, its price-to-earnings ratio exceeded 70. That means investors were betting that profits would explode over the next several years. Even if they actually do grow, the stock might not rise. Miss expectations by even a little, and you get a crash. This actually already happened on a smaller scale in 2024. NVIDIA beat earnings expectations, yet its stock dropped nearly 10% in a single day. The reason? Not good enough. Expectations had gotten too high. When this happens in a major bubble, it doesn't end as just a temporary correction. There's one more thing. The more the gap between these two markets widens, the larger the optical illusion effect becomes for the market overall. The S&P 500 index is going up, so it looks like the economy is healthy. But half the market is already quietly declining. When this gap crosses a critical threshold, the reality that's been hidden comes crashing into prices all at once. That's the second trigger. Reason 3. The safety net is actually extending the bubble. At this point, you might be thinking, surely when unemployment gets serious, the government steps in, increases spending, creates job programs, expands welfare. Then consumption gets supported and the bubble just deflates, right? You're correct. The government does intervene, but here's the twist. Government intervention doesn't pop the bubble, it actually extends it. And it makes it pop from a higher place. This is what I consider the most important of the 3 reasons today. Because this is the element people find most reassuring. The thought that the government is there actually creates an even bigger illusion. When AI increases unemployment, the government politically can't do nothing. Elections are coming, so they expand unemployment benefits, increase infrastructure investment, create government job programs. In the short term, this actually works. Consumption holds up, unemployment statistics stabilize, stocks stay up. Superficially, everything looks fine. What is ghost GDP? But there's something government spending can't fix. It doesn't actually replace the productive private sector jobs that AI eliminated. When the government spends money to create jobs, those jobs don't generate the innovation and productivity that private sector jobs create. GDP numbers go up, but the real economic vitality doesn't. I call this ghost GDP. The numbers look fantastic. GDP growth of 3%, unemployment at 4%, stock market at record highs. But actual household purchasing power is declining, middle-class real assets are shrinking, and more people are getting by on debt. Prosperity in the numbers, but quietly deteriorating reality. That's ghost GDP. Historically, this situation has always led to inflation. When the government keeps supplying money without actual productivity increases, more money circulates in the market, but the supply of goods and services doesn't grow proportionally. The result is inevitable. Prices rise. When inflation goes up, the central bank raises interest rates. And that's when the killing blow lands on AI tech stocks. Growth stock valuations are calculated by discounting future profits to present value, and when interest rates rise, that discount rate gets bigger. In simple terms, the higher interest rates go, the lower the present value of future profits becomes. Stocks of AI companies that are betting on future growth are particularly vulnerable to rate hikes. The higher you fall, the real paradox of government intervention is this. Without intervention, the market would have corrected early and absorbed the shock at a lower level. But when government intervention extends the bubble, the market rises higher, more people invest at the peak, and when the crash comes, far more people get hurt. The safety net is actually raising the height of the fall. That's the third trigger. And it's what worries me most, because this structure can't be stopped politically. No government can say we won't intervene. And even if that intervention worsens things long term, the consequences take years to show up. So short term, it looks like good policy. So what should you do? I've outlined 3 things. AI productivity gains not circulating into consumption, extreme concentration of benefits, and the paradox of government intervention extending the bubble. All 3 are operating simultaneously. So what should you do? First, distinguish between 2 markets. Just because the overall stock market is rising doesn't mean the economy is healthy. While 7 companies are pulling up the index, you need to watch what the other half is doing. The performance of real economy sectors, consumer goods, retail, regional finance, acts as your warning light. Second, look beyond the headline numbers. Don't just look at GDP growth rates or unemployment figures. Watch household savings rates, credit card delinquency rates, real wage growth rates. These are what distinguish ghost GDP from genuine economic growth. Third, watch interest rate direction. The ultimate trigger for the AI bubble is inflation and interest rates. If inflation pressure starts rising again while government spending keeps increasing, that's the clearest signal that the bubble's endpoint is approaching. What I'm telling you today isn't sell everything right now. When the same event hits, people who understand this structure and people who don't will make completely different decisions. Some panic sell, some chase higher prices at the peak, others calmly read the structure and move accordingly. I hope today's discussion helps create that difference. Thank you.